What if I told you your Bitcoin could help you buy a house? This week, crypto just got a seat at the mortgage table, but the fine print could cost you more than you realize. Welcome to Confidently Crypto, the podcast that keeps you ready for what's now, what's new, and what's next in the digital asset economy. I'm your host, Dr. Tonya M. Evans, professor, fintech advisor, and your chief learning optimizer, here to help you demystify crypto and take confident control of your financial future. And if you're new here, make sure you follow the show and tap that subscribe button so you never miss an episode. And of course, if you're a returning listener or viewer, you already know this is where smart people come to go from crypto curious to confident. And if you want to go to the head of the class, head over to proftanyaevans.com, download our tools and resources, dive into on-demand trainings, and join the movement for digital wealth building on your terms. Now, let's start as we always do with this week's state of crypto. So it's been a powerhouse week in crypto. Let's break down the top headlines. First up, Bitcoin ETFs hit $1 trillion in trading volume. Bitcoin exchange traded funds in the United States surpassed 1 trillion in cumulative volume after 10 straight weeks of inflows, including $1.1 billion last week alone. And that brings the year-to-date investments to over $15 billion equivalent in the US dollar. Translation: Wall Street isn't just dabbling anymore, they're diving in on their own terms. But don't panic, sell your bag into their greedy TradFi hands. Next up, Ripple versus the Securities and Exchange Commission. That suit is finally over. Both Ripple and the SEC have dropped appeals in the years-long XRP case. The path forward looks clearer for Ripple and the broader crypto community. Translation: with this cloud lifted, XRP may finally step into the sunlight. It's good for them. Congratulations. Next up, Edelman ups crypto allocation to 10 to 40%. Wow. So Rick Edelman now recommends clients hold 10 to 40% of their portfolios in crypto, up from 1% just in 2021. Mainstream? Absolutely. Also, MasterCard is embracing Fi USD, a new stablecoin in partnership with a company called Fiserv. So MasterCard is integrating the Fi USD stablecoin into their global payment rails. And that means 150 million merchants could soon settle with digital dollars. Let's just hope that they pass those savings on to you. And next, the government pledges market structure legislation by the fall of 2025. The current administration and the Director of Digital Assets have committed to crypto market structure legislation, and they have a major push on a bipartisan basis in Congress. We should expect something to happen by September of 2025. Devil's always in the details, of course. And so we'll just have to stay tuned to see how quickly or not market structure moves through Congress. They have a few other things that they're working on. I don't know if you've been paying attention, but if you don't know, you should get up to speed on everything that's going on with the tax cut bill and its implications, not just for finances, but literally for the livelihood and well-being of the citizens of this country. Taken in totality, from ETF inflows and stablecoin rails to federal policy shifts, crypto is moving fast, but mass adoption doesn't mean equal mass empowerment. Understanding the terms of engagement is everything. So let's turn to our main story for today. The Federal Housing Finance Agency just made a historic move. It has instructed Fannie Mae and Freddie Mac to begin accepting crypto assets held on centralized U.S. regulated exchanges as valid reserves for mortgage applications. Translation: you no longer have to liquidate your Bitcoin or your ETH in order to meet FHA reserve requirements. And that's huge. If any of you have wanted to purchase a home and you're looking across your assets and you hold more crypto than you do dollars or other assets, real estate, stocks, etc., having to liquidate that in order to come up with the dollars is a big deal. And particularly for crypto, liquidating your Bitcoin, for example, just doesn't disrupt your portfolio. It triggers a taxable event because crypto is taxed as property. So, depending on how long you've held it, how much it's appreciated, that could mean a capital gains tax hit that slashes your buying power. Now, this policy opens the door for millennials and Gen Z investors who are digitally native, self employed professionals who've built digital first wealth, crypto native folks who've been locked out of traditional mortgage assessments, those who have been locked in or locked out of W 2 income. But, and there's always a but, and this is a big one, this only applies if your assets are held on centralized exchanges like Coinbase or Gemini. If you're self custodying your crypto on a ledger or Trezor or using DeFi protocols, you are SOL, at least in this current turn of this policy. So let's talk about trade offs. This is TradFi inviting crypto to the party, but only if it wears a TradFi costume. So follow me now. Centralized exchanges are becoming the gatekeepers, the new gatekeepers of legitimacy, and that's a double edged sword. So, first off, you have custody risk. If you don't hold your private keys, you don't truly own your assets. Not your keys, not your crypto. And hacks? We've seen plenty from Mt. Gox to CoinCheck, Liquid. If the platform goes down, then so could your balance. Up next is bankruptcy risk. Remember Celsius, FTX, Voyager. Customers lined up with paper wallets and screenshots and still lost billions because assets held on the platform were pulled into bankruptcy proceedings. And of course, there's always surveillance and control. Centralized platforms require full KYC, and your data is subject to government requests. Add in volatility buffers, custody limitations, and institutional gatekeeping, and you've got a lot of fine print hidden under the headline. So, yes, crypto now qualifies or soon may be able to qualify for home buying, but only if it checks TradFi's boxes. In my humble opinion, that's not autonomy, that's assimilation. And while traditional finance takes baby steps, DeFi or decentralized finance is sprinting ahead. So, DeFi allows you to borrow against your crypto, earn interest, uh, access liquidity without asking for permission. And here's how it works: you deposit assets like ETH or USDC or the newly rebranded USDS, which is formerly DAI, and you borrow against them via smart contracts, which are automated bits of code that executes trustlessly. It's kind of like an if then scenario. So platforms like Aave and Compound, the former MakerDAO, Liquidity, Morpho facilitate billions in loans daily. And as of June 2025, DeFi lending protocols hit a record 55 billion total value locked, or TVL, and 26.3 billion in active loans. Aave alone handles over 60% of that business. So, why users are opting into DeFi lending? Well, you keep your keys, you avoid taxable events, you earn passive income, and you access borderless, permissionless finance. And with platforms like Morpho, which match lenders and borrowers directly while still integrating with trusted protocols like Aave, The experience is getting more efficient and accessible. It's not all the way there yet. There is a huge user learning curve, excuse me. So, not for the faint of heart. The UI and UX will get better. It is better than when I entered the space in 2017, 2018, but there's a long way to go. So I'm not suggesting this is easy, but it is possible. And so let's talk about the other side of the proverbial or actual coin. DeFi isn't risk free. Liquidation is real, so a market drop could erase your collateral. Smart contract bugs or governance attacks can certainly compromise funds. There's no FDIC, no customer service line. Self custody means self responsibility. DeFi is powerful, but it's not very forgiving. So you have to learn before you leap, but you can do this, and Confidently Crypto certainly can help. So, what's the big takeaway? We're at a fork in the road. Two paths, two philosophies, FHA backed TradFi, crypto held on centralized exchanges, counted as reserves. DeFi, self sovereignty, crypto in your control, leveraged on your terms. The FHA's move is historic. It says crypto has arrived, but it also says only this kind of crypto counts and under these circumstances. If you've read my book, Digital Money Demystified, you know this moment was coming. So ask yourself, do I want my financial freedom approved or earned? Using your Coinbase balance or Kraken or Gemini to qualify for a mortgage, it's progress, no doubt about it. But surrendering custody for legitimacy, that's not sovereignty. It's certainly not Satoshi's dream. Real crypto power comes when you write the terms, when you own the rails, the wallet, and the wealth. So, whether you're building tools, writing policy, or just learning the ropes, this is your moment, because the real race isn't about being accepted by the system we came to disrupt. It's about building one that doesn't need permission in the first place. If this episode got you thinking differently about crypto, credit, and control, make sure you're subscribed wherever you listen or watch. Of course, if you're watching on YouTube, tap that like button, drop a comment, share this with someone who needs to hear it. And want to go to the head of the class, head over to proftonyaevans.com. That's Prof, TONYAEVANS.com for exclusive resources to help you build your digital asset confidence personally and professionally, from custody to credit to your professional power moves and everything in between. And don't forget, if you're loving the show, leave a 5-star review on your favorite podcast platform. It helps more people discover the show and join the movement toward financial sovereignty. This is your Chief Learning Optimizer, Dr. Tonya M. Evans, reminding you to stay curious, stay safe, and stay confidently crypto.